Welcome back to another video of this 5-video series on what I look at when I want to invest in a company. Have you ever spoken to someone and it was just, they just sound like Albert Einstein? Like they are just too clever for you and you just immediately think, this financial stuff is not for me. Well, in this video, we are gonna dumb it down, make it easy for you. Well, I made it easy for me, so I'm gonna show you how I made it easy. And we're gonna go through it. We'll be looking at the debt to equity ratio and the free cash flow because those two go hand in hand. Right, so now that we're getting to the financial stuff of companies, I'm going to show you what they are. I'm going to show you how to calculate them, and if you don't want to calculate them, I'll also show you where to go find them so you don't have to be an accounting specialist. The two places I definitely go to, well, 3 places I go to find financials: investing.com, Yahoo Finance, and TradingView. But for this video, I'll be showing you on Yahoo Finance and on TradingView. So Yahoo Finance, you can find the full balance sheet, income statement, cash flow, the whole works, and you can go calculate something when you can't find the ratio, but you can also find the ratios on there. TradingView, on the other hand, great for just quickly getting the ratio. They don't show all the financials in a quick view. Yeah. So on Yahoo Finance, you can go look at the financials, you can look at the income statement, the balance sheet, and the cash flow. And if you go to the statistics, you can go look at all these ratios. Now, remember that the DE ratio they show here is a percentage. So don't get a fright when it says 134 and I just told you a good DE ratio is below 2. You know, don't freak out, it's a percentage. On TradingView, you can go down to the bottom, just below this gear, this speedometer over here, and then you can go look at all these different ratios, any indicators, forward, trailing, you can find everything here. But always, if you can't find a specific ratio or financial indicator, go to the company's website, go to the investor section and just go look for it yourself, get the financial report and you can get it. Follow the instructions I'm going to tell you in here and you can easily go calculate it. And the first thing I always look at, you will find on the cash flow statement, it's the free cash flow. What's free cash flow? It's literally in the name. It's cash that are free for them to use. So it's flowing, you know? So it's after all their expenses, after paying their dividends, after all that. It's money they have left, and that money they can use either to reinvest into the company and grow the company, or amazingly, they can decide to pay out a section of that into dividends to you, a shareholder. So I always say, you need to decide what type of stock you want to invest in. Do you want to invest into a growth stock that might not be paying dividends out because you are only banking on the growth of it? Or are you investing into a stock that will pay out dividends? But we'll get to that. The free cash flow is a great indication of how healthy a company is. Are they liquid? Do they have enough cash to actually go forth, grow, or give back to their investors and actually handle what's coming up? And free cash flow is also a great way of seeing if a company will be able to survive, for instance, the pandemic. A company with a lot of free cash flow would have managed throughout the pandemic a lot better than a company who had no free cash flow. And the most important thing about free cash flow is it shows if a company can pay off their debt. A company might have huge amounts of debt and they might have very attractive this and that, but if they don't have cash to pay back their debt eventually, they will suffer and they will struggle. So this is a great indication. You can, for instance, look, what is the debt value of this company? What is their free cash flow available? Can they start paying off pieces of this debt? So free cash flow is the money left after expenses. That's what you need to know. It's like you get 100 Rand from a mate to go do some shopping and he tells you you can leave whatever is left over. So you buy all these things and you've got 20 Rand left. You've paid your expenses, you've factored in your petrol, and now you've got 20 Rand left. That 20 Rand you can go use to grow yourself. The debt to equity ratio. The debt to equity ratio is calculated by taking the total liabilities and dividing it by your shareholders' equity, or sometimes referred to as your owner's equity. So we all know what debt is, and we'll get to what equity is. But all you need to know is that the debt to equity ratio varies from industry to industry. So it's very important. And with most of these ratios, you need to evaluate the ratio value you get within their industry. Some ratios you can compare cross industry, but the debt to equity ratio especially, you only evaluate for similar companies in that industry. So simply put, the debt to equity ratio is what you owe to what you have. A good DE ratio falls below 1. Now, our ideal DE ratio will be about 0.65, 0.68, round about there. But again, so you got to compare within industry. Let's say you're looking at the construction industry. They normally have a very high DE ratio, up to 1.5, maybe even 1.8, round about there. Sometimes you get very good construction companies with a 1.2 or 1. So the reason for this is construction companies, before they start their project, take on a lot of debt because they only get paid at the end of their site completion when they get their money back. So that's why they've got a lot of debt. Generally, a DE ratio larger than 2 is not ideal. So that's when you need to start looking at what the company is doing with their debt. Why do they have so much debt? And is it maybe gonna be able to be paid back? And then that's when you refer back to the free cash flow and other stuff. The financial industry also a lot of the times can have DE ratios quite high, even utilities. If you look at, for instance, a company like Next Era Energy, they might have a high DE ratio because they have to acquire all these generation facilities, and that's a lot of initial debt. Please remember, one ratio will never tell you how a company is going to do. You need to look at more than just one. Right, so stick around for the end credit scene, because from now on, at the end of my videos, at the end, I'll be telling you a little something about Tesla, because I'm Tesla crazy. Thanks for watching, and see you guys. Remember Battery Day on 22nd of September. Watch it live because big things are gonna happen. And it'll also explain why I'm so crazy about it and why I just love it. Fun fact about Tesla, I bet a lot of you did not know that Tesla has a huge supercomputer. They call it the Dojo. So go look up on that a bit. Bet you did not know that Tesla has a huge supercomputer that, if completed, it might be the best in the world.